Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Invesco mortgages stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Invesco Mortgage is a real estate investment trust. The trust purchases and manages residential and commercial mortgage-backed securities and mortgage loans. A mortgage-backed security is an investment similar to a bond that is backed by a bundle of mortgage loans. Investors in an MBS receive periodic interest payments similar to a bond coupon payment. Say, for example, there's a bond backed by 1,000 mortgage loans, and say 10 homeowners default on their loans. The bondholders will still get 100% of their principal and interest payments. If, say, 200 people default on their loan, then the junior bondholders may suffer losses. Since the junior bondholders shield the senior bondholders, meaning the junior bondholders take losses first, that means the junior bondholders receive a higher interest payment. Maybe the coupon for a junior bondholder will be 6% and the coupon for a senior holder will be 4%. If in that same example 300 people default on their loan, then the senior bondholders may start to suffer losses. The stock price of Invesco and other mortgage REITs went down about 80% in March 2020 during the COVID pandemic. Recession fears tanked the value of mortgage-backed securities. The company is headquartered in Atlanta, Georgia, and was founded in 2008. The ticker trades on the New York Stock Exchange, Deutsche Börse, and London Stock Exchange. Let's get started with the model. This is a small cap company, 500 million market cap. They're trading at $15 a share, and they have 33 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have positive free cash flow each year. It was higher in 2019 at 340 million. It's down to 158 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was positive in 2019, a big negative in 2020, also a negative in 2021 and the trailing 12 months. Revenue is their interest income, the interest they receive on their investments. And that's gone down a lot from 778 million to 171 million. This is their income statement from their latest 10Q, the first quarter of 2022 versus the first quarter of 2021. They received 42 million of interest income. This is the interest they received on their MBS and CMBS investments. It was 40 million last year. Most of it is from mortgage-backed and other securities, some from commercial loans. This is when you provide a loan to a company. Like, for example, if Google wanted a $1 billion loan, because not all loans are part of CMBS or MBS vehicles. Some are just single loans done with a bank and not put into an SPV. And their interest expense was negative 2.1 million, so they had a gain in interest expense. So their net interest income is 44 million. Last year was 42 million. You can see it says repurchase agreements here with a footnote. Let's look at that. They had to pay 3 million of interest expenses on their repo agreements. And there was a gain of 5.2 million on amortization of net deferred gains on D-designated interest rate swaps. D-designated means a termination of interest rate swaps. Repo agreements are how companies like this get funds to buy their mortgage-backed securities. A repurchase agreement or repo is a short-term agreement to sell securities in order to buy them back at a slightly higher price. The federal government offers repo agreements for companies like this to buy government bonds like Ginnie Mae and Fannie Mae. So this company can't use the funds to buy other securities like common stock. They have to buy government securities. They usually pass through large unrealized gains or losses on their investments. But this gets reversed out in the statement of cash flows. This loss of 500 million is a mark-to-market loss, so we'll see this added back on the CFO section in a little bit. Then they had a gain of 239 million on derivatives. we'll minus this out on the statement of cash flows. So in the first quarter, they had a net loss of $237 million. But the income statement doesn't give us much information for companies like this. It's better to look at the statement of cash flows. This is the company's statement of cash flows from the 10Q, the first quarter of 2022 versus the first quarter of 2021. So even though they report an accounting loss of $228 million, they actually generated $40 million of cash flow. We have to minus out the derivatives gain and add back the loss of $500 million. Holding companies like Berkshire Hathaway have to pass through lots of unrealized gains and losses. So let's say Berkshire Hathaway or any holding company bought a stock for $100,000. And say at the end of the year, the stock was worth $300,000. They're still holding the stock. They didn't sell it. So they have to pass through a gain on their income statement of $200,000, an unrealized gain. So this will improve their 2021 net income. But say in 2022 it's a bear market and the stock goes down from $300,000 to $125,000 by the end of the year. They have to post an unrealized loss of $175,000, so it makes their net income look pretty bad in 2022. So after 2 years, this company bought the stock for $100,000 and the stock is trading at $125,000. So they're up only $25,000, but they passed through this large gain in 2021 and this large loss of $175,000 in 2022. But the stock only went up $25,000 in 2 years. So you can see how unrealized gains and losses really skews the numbers. That's why you should look at the operating cash flow. And can you imagine if a holding company had 100 stocks like this? Multiply this gain by 100 and this loss by 100. You could see how wacky the numbers become. In the first quarter, they bought $7.6 billion of mortgage-backed securities, and they sold $8.8 billion. They also purchased $500 million of U.S. Treasury securities, and the funding is mainly from repo loans. They received $23 billion of proceeds in the first quarter and repaid back $24.5 billion. This is as of 3/31/22 and 12/31/21. They have $6 billion of MBS, $500 million of U.S. Treasury securities, $250 million of cash, $250 million of restricted cash. The restricted cash is cash that's set aside for interest rate swaps and currency forward contracts. $50 million due from counterparties. This is collateral pledged on repo agreements and TBAs. TBAs are to be announced security forward contracts. So these are options to purchase RMBS. $15 million of investment related receivables. That's accrued interest receivables on their MBS portfolio. $18 million of derivative assets and $29 million of other. This is their liability section on their balance sheet. $5.8 billion of repo agreements, $78 million derivative liabilities, $30 million of dividends they owe to their shareholders, and a bunch of other smaller numbers. Here's a breakdown of their investment portfolio in the first quarter. 92% agency RMBS. Agency RMBS is residential mortgage-backed securities whose principal and interest payments are backed by quasi-government agencies such as Ginnie Mae, Fannie Mae, and Freddie Mac. 6% of the portfolio is U.S. Treasuries, 1% credit portfolio. Here's a breakdown of their $98 million credit portfolio. 5% in joint ventures, 63% in non-agency CMBS. These are bonds backed by commercial mortgage loans. When it says non-agency, then that's usually a bank that issued the bonds, like JP Morgan or Goldman Sachs. Then you have non-agency RMBS, residential mortgage-backed securities, and 24% commercial loans. A commercial loan is between a bank and a business. So like that example I said earlier, if Google needs $1 billion, they'll go straight to a bank to get the money. And the bank may just hold the loan and not put it into a CMBS. 90% of their securities are rated single A or higher. AAA is the highest credit rating. It's the least risky. Then AA, single A. Then BBB is still considered investment grade. BB is below investment grade. Then there's single B, then CCC. And 1% of their portfolio are agency interest-only bonds. So these are Ginnie Mae or Fannie Mae interest-only bonds. Their WACC on Finbox ranges from 7.8% to 9.5%. I used the highest one of 9.5%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows, past year 4, that's $2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2 billion. We divide that by 33 million shares, and we get a calculated stock price of $60. They're trading at $15, so they're trading at a 74% discount. It's a buy according to the model. So it's really hard to value a company like this. I just grew their free cash flow 5% each year. That's how I got their future free cash flows. 2 analysts priced this stock, and the average price target is $18. The low is 16, the high is 20. This is where the stock has been trading the last 5 years. As I mentioned in the opening, mortgage REITs crashed in March 2020. You can see the stock went down a lot. And then it was kind of trading sideways for a while. And it decreased a decent amount in 2022. But it still pays a really generous dividend payment. And you can see they did a reverse stock split. So if you bought this stock a few months ago, it wasn't trading at $15, $20. They did a 1-for-10 reverse stock split since the stock price was getting close to $1 and they didn't want to get delisted. So in July 2020, it looks like it was trading at $50 a share, but it was actually trading at $5 that day. All the numbers before June 6, 2022 have to be stock split adjusted. So they will all multiply by 10. In the past 5 years, this stock is down 91%. The ticker REM, the iShares Mortgage Real Estate ETF, that's down 41%. Those two investments were tracking each other before COVID, but once COVID hit, this stock crashed a lot more than its competitors. If you want to invest in that ETF, the biggest holding is Annaly at 14%. I did a video on that company. Then Starwood Property, AGNC, New Residential, Blackstone, Arbor Realty, Chimera Investment, Hannon Armstrong, Two Harbors, and Apollo Commercial. And this company pays a sick dividend, 23%. They pay 90 cents per quarter. So if you take 90 cents, multiply it by 4, that's $3.60. Take that number and divide by the stock price. That comes out to 23%, which is 69% of their free cash flow, so it does appear they can afford the dividend payment. They pay their next dividend on July 27th. So if you want to get this dividend, you have to own the stock before July 8th. If you buy it on July 8th or after, you will not get the July 27th dividend. Here's a chart of their dividend yield the past 10 years. When the stock price crashed, the dividend yield shot up to over 60%, which is really unheard of. Obviously, a company cannot sustain a 60% dividend yield, so it came crashing down. But the forecast is for the yield to go to 22% by 2023. They have a beta of 1.3, so the stock is a little more volatile than the market. It's down 56% in the past 52 weeks, while the S&P is down 12%. The 52-week low is 10, the high is 37. And the stock is on a downtrend, trading below its 50-day and 200-day moving average. 1.6 million shares are traded each day on this stock. Of the 33 million shares outstanding, 32.9 million are on float, 5% are held by institutions, and 15% of the shares are shorted. If you put $10,000 into this company 10 years ago, you'd be pretty unhappy at $2,400 today. That's a 76% loss. In the past 12 months, lots of different insiders have been buying. There has been one sell for 2,100 shares about a year ago. The stock price is $15, so some of these people bought at 30 or a little higher. So they're already down 50%, and it's only been a few months since they bought. The biggest shareholder is BlackRock at 17%, then Vanguard, State Street, Murray Asset Global, Geo, Susquehanna, Northern Trust, Citadel, BNY Mellon, and Charles Schwab. The best way to look at ratios is to compare them to companies in the same industry. There are 40 companies in the same industry as Invesco, and if Invesco has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So lots of companies pay really big dividends in this industry. They are paying higher than average at 23%. The average is 11%. They rank 27th in market cap of the 40 companies. Price to book is probably the best ratio when looking at this type of company. We can't look at their PE since they have negative net income. They have a good price to free cash flow and price to sales, and their revenue is lower than average. So to summarize, I have them trading at a 74% discount, and this is a tough stock to buy. A lot of people don't really understand how they make money. They borrow most of the funds from the Fed using repo agreements. Then say they pay the Fed a 3% interest rate. They buy mortgage-backed securities that pay a 5% interest rate, and the spread of 2% is how much money they earn. Of course, there's a risk that some of those bonds may default, or there's a risk interest rates may shoot up because of inflation, and when interest rates go up, bond prices go down. Same thing when interest rates decrease, the value of bonds increase. But I know lots of people are buying the stock hoping it goes up a lot because it lost so much the past few years. Plus, they pay an unreal dividend payment. I rank their free cash flows 5 out of 10, their revenue 5 out of 10, and their ratio 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.